Good morning, everyone, and welcome to Wednesday's update with Foundation Fund Managers. Hayden Little, the CEO of Foundation Fund Managers, will be sharing a little bit about the market updates locally and internationally, what's happening with the Rand. I'm from the Quattro Finance Group, and I'll be asking some questions this morning and hopefully give you some insight as to what to be doing with your investments going forward. Hayden, welcome again. Thank you so much for spending your time with us this morning, and I hope that you give us some good insight as to what to be doing and where to be putting our money.
Sure, thanks, Gary. Good to chat again. And before we get into it, just a quick thank you to you and the whole Quattro team. Last weekend, you put on an amazing evening for the Quattro annual awards. It's always a pleasure attending those functions with you guys, and really very encouraging to see how your top performers continue to shoot the lights out despite what the market throws at them. So yeah, well done to your team, and it was a cracking evening.
Fantastic. Thank you, Hayden. So Hayden, last week we had a chat around the Rand, the new jobs data that came out from the US, and the Rand strengthened quite significantly to around about the 13.95 level to the dollar, and it's still been trading around about the 14 Rand mark today. So have we traded sideways for a week, or has there been any more action in the market with regards to our pricing?
Yeah, you know, we spoke this time last week and we were in and around 14 to the dollar. Here we are this morning opening at 14.02. So on the face of it, it looks like nothing's happened, but that's definitely not the case. And as we know, the Rand, one of the more volatile emerging market currencies out there. So it's never plain sailing for us. The last few trading sessions, or prior to the last few trading sessions, I should say, we've had a number of local developments that have impacted the Rand. Some positive pointers, which have been great to see, but the last week really has all been about international factors. And we've been reminded that at the end of the day, we really do take our cue from what happens primarily in the US and to the dollar, and then to the other developed market currencies as well. So this time last week, we were waiting for the US inflation print, consumer inflation. Inflation around the world has been a bit of a hot topic, and it's expected to pick up primarily because the base effect, you know, the year-on-year inflation prints are measuring prices today against March, April, May last year, 2020, which was pretty much at the height of the COVID panic. And at that point, there was no demand, so prices were low. And so in the US, they were forecasting a pickup in inflation to 3.6%, which itself is a very high number, but economists understanding that it's an artificially high number. A more realistic measure, I suppose, is the month-on-month inflation print, which would have just measured February to March, and i.e. that in 2021, and that's you know, that kind of removes looking at what happened in the pandemic and gives a more accurate gauge on where inflation is moving in the US. So the year-on-year print was supposed to be 3.6%, a high number. The month-on-month print was supposed to be 0.2%, which for the US is actually quite aggressive. The numbers really shot the lights out. Year-on-year came in at 4.2%, and all the commentators that I follow on Bloomberg and CNBC and Reuters almost fell off their chair. I mean, nobody could even imagine the US inflation going up as high as 4.2%. But more tellingly, their monthly inflation print came in not at 0.2%, which would have been aggressive, but in fact at 0.8%, 4 times the forecast. We all know that inflation is lurking in the depths. Is it demand-driven inflation? Is it supply-driven inflation? As you know, companies struggle to produce enough raw materials and goods to satisfy demand. But at the end of the day, this really aggressive tick up in inflation spooked the market. US treasuries shot up from 0.6% on the 10-year to, sorry, not 0.6, 1.6% on the 10-year to 1.69% in a heartbeat. And higher treasury yields as a result of inflation fears drove dollar demand, and the Rand went from 14 Rands to the dollar to 14.14 in a heartbeat. So yeah, it's definitely caught us by surprise and hurt the rand.
Brilliant. So we've looked at the local and international financial news outlets, and there seems to be this fixation, as you've spoken about, with rising inflation. Rising inflation obviously would support the dollar, but we're still sitting around about the 14 Rand to the dollar mark. Why is that?
Yeah, it's an interesting one because, inflation chatter hasn't gone away. In fact, last week, in fact, no, not last week, Monday this week, we had another data release, an inflationary data release in the New York State manufacturing input prices. And that came in, I forget the exact number, but it was a 12-year high or a 15-year high in terms of price elevation in that sector. So there's lots of pockets of inflation indicators coming through in the US market. However, one of the items that we really were focused on Friday last week was their retail sales number. Retail sales, when retail sales picks up, that's an increase in demand for goods and services. Increase in demand, of course, then allows your suppliers to hike their prices, and it's inflationary at the end of the day. March 2021 saw an absolute banner number in the US for retail sales. Again, they're used to a couple of percentage points expansion or contraction, depending on what's happening at the time. But March delivered a 10.7% increase in retail sales, primarily off the back of a huge amount of stimulus that got sent out in March or late February. I don't know how closely people follow it, but the US have been sending out $1,400 checks per person, per household. I mean, it's an amazing situation that they find themselves in to try and support their economy. So everybody had more money in the back pocket, and by default, they all went out and spent it in March, and retail sales picked up. April was supposed to follow suit, maybe not as aggressive, but definitely in expansionary territory. And the surprise on Friday was that retail sales in April was flat, 0% growth. And that caught the market unawares. So just as a higher number in inflation on Wednesday spooked the market and drove the dollar higher, a flat retail sales figure on Friday calmed inflationary fears. And that, coupled with a lot of Fed members going out into the market and telling or reassuring the market that inflation is going to spike, they know it's going up. They see it as being transitory, meaning that it'll go up and come back down in the not too distant future. Plus retail sales cooling off, plus a number of other factors like the UK. The UK on Monday started to open up their economy. Brits are now able to, they say go abroad on essential travel, but CNBC had some reporter stationed at Gatwick Airport on Monday morning, and there were people going out with their umbrellas and their surfboards and all sorts of holiday equipment that is definitely not used on essential travel. But it's just it's a feel-good factor that allows the UK to get back to a sense of normality. Europe is doing the same. And with the Fed calming inflation fears, with Europe opening, the risk-on sentiment came back in and brought the rand right back. 14.14 on Wednesday, Thursday last week, back to the 14s and even 13.96 yesterday as a result.
Oh, that's fantastic. So Hayden, big question, predicting the rand's next move. I always ask you, you always err on the side of caution and say it's a tricky task. But any news? Is there anything out there on the local front, or is this potentially only internationally driven, this rand movement strengthening against the dollar?
Yeah, so you're right. The rand, one of the more volatile emerging market currencies, and I've been in this game now for 13 years. I wouldn't know where the rand's going in an hour's time, let alone what the general trends are. However, the last couple of days really have given us an opportunity to be quite confident in our predictions. And for those who follow our daily rand reports, I actually opened the report this morning saying exactly such. On Monday, I called for a stronger rand, and it strengthened. On Tuesday, I said the same was going to happen, and it strengthened. And I'm going for my hat trick today. I do think that the rand is going to strengthen further from where we are now. Of course, anything's possible, and we could find ourselves back at 14.14 or worse. But right now, it looks like dollar weakness is the theme of the day. And I'll get to that in a moment. On the local front, we've got our consumer inflation print at 10 o'clock this morning. Just like in the US, our CPI is forecast to tick up quite aggressively. Inflation has been hovering around 3%, 3.2%, right at the bottom of the Reserve Bank's target range of 3 to 6%. But inflation today, consumer inflation, is forecast to come in at 4.2%. That's an annual or year-on-year measure. The move from 3.2 to 4.2 purely because the 4.2 is looking at this time last year when our prices were suppressed thanks to the pandemic. It's not a number that's going to spook the market because we're expecting it to be high. Yeah. Even at 4.2%, it's going to be below the 4.5% bid rate that the Reserve Bank keeps as their ultimate goal. We've also got retail sales figures coming out today. Our local retail sales at 1 p.m. They're expected to be comfortably in expansionary territory, which is rand positive. And then we get our Reserve Bank announcements tomorrow. Interest rates in SA. Every single economist that's been polled across all of the polls that I've seen at Bloomberg and Reuters and Business Day and various other news outlets, every single one says that we should keep interest rates unchanged at 3.5% as the repo rate, which means prime stays at 7% for you and the consumer. Low interest rates are good for economic activity. Improved economic activity is good for the rand. But the main reason I feel that the rand is going to strengthen against the dollar today is primarily because of continued dollar weakness. Later this afternoon, we get the latest Federal Reserve meeting minutes. These minutes, or that meeting, took place before last week's blowout inflation print. So they had no clue that was coming down the pipeline. It would not be factored into anything they spoke about in that meeting. And again, everything I'm reading is saying that the minutes are going to be incredibly dovish, i.e. the Fed saying they're not going to change their monetary policy for the foreseeable future. They're going to keep interest rates low, going to keep buying assets at $120 billion a month in bonds and mortgages. And that's all very dollar negative. So I believe that a move back below 14 is on the cards if the stars align like they should.
Just want to ask, so the Fed's stance to not increase interest rates, is it because they believe the inflation rates are short-term, or are they just biting the bullet? What is their main driving reason? I mean, surely they're getting so much pressure with inflation to do so.
Yeah. There's a huge amount of chatter about this out in local and primarily international news outlets. Up until recently, the Fed has always been very proactive in trying to stop the US economy from overheating. So with inflation, there's a bit of a butter zone. You know, in SA, we've always tried to bring inflation down. It's been too high at 6, 7, 8%. Other economies like the US try to push inflation up. They've been stuck at 0.5% or 1% inflation. And if you get no inflation, there's no incentive to have wage growth, and people can't earn more and improve their lives. They just get stuck in a rut. Yeah. And the Fed has set 2% as their target inflation rate for the past 12 years. They've always tried to get to 2%, and they've not achieved it. And the thinking is that they haven't been able to achieve 2% inflation. They've always been below, because every time there's little signs of inflation coming through, they've been too quick to hike interest rates to stop inflation shooting past 2%. They worry about going into 2.5% or 3%. And so they put the brakes on, and perhaps put the brakes on too soon, and they don't actually get to 2%, which is their goal. Jerome Powell, who is the current Fed president and has brought a whole new way of thinking to that committee, has said that they're happy to have an average target of 2%, meaning that they've been below 2% for a long time. It allows them to be above 2% for some time, to have an average of 2%. And so they're letting inflation run hot, which will bring their average up, but also at the same time saying that inflation right now is also being measured against very low base effects last year. And so it's transitory in nature, i.e. it's going to go up to your 4.2% we saw last week, and perhaps hover around that level for a month or two, but then come back down once the COVID base effects from 2020 work through the system. Yeah, it's all a big experiment. We'll see what happens, but at the moment, the Fed are sticking to their guns.
Well, it sounds like a great opportunity to invest in some international currencies with our strong rand. So thank you very much for your insights today. I hope you have a phenomenal week, and I'm looking forward to next week's updates, and perhaps a bit of reflection on what happened today would be great as well.
Yeah, absolutely. Thanks, Gary. Fingers crossed this time next week. We're talking about a number in the mid to upper 13s against the dollar, but anything's possible. And we'll see what happens.
Fantastic. Thank you so much, Hayden.